Picture this. You open your brokerage app on a quiet morning. You see your QQQI shares paying you every single month. You feel good about it. Then a friend forwards you a video about a brand new fund. He says the new fund pays the same kind of income. He says you keep more of it after taxes. He calls it the smarter version of QQQI. So you sit down at the kitchen table, you start to make the swap. Your finger hovers over the sell button, and then you notice something on a tax document that stops you cold. That actually happened to a retired couple from Tampa, Ray and Marjorie, both 68. They almost dumped their QQQI position last fall. The new fund looked like a no-brainer, but one number on the year-end tax form changed their whole plan. In the next few minutes, I'm going to show you what that number is, why the most talked about new income ETF is not exactly what its marketing claims, where this new fund actually belongs in a portfolio, and how the right choice between these funds could mean thousands of dollars more in your pocket every single year. Money that stays with you, not with the IRS. And the part most people miss is this. The difference between these funds is not in the yield. It is not in the holdings. It is in one single line on a piece of paper most investors never even read. Quick note before we go any further, I'm not a financial advisor or a government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. So now let's talk about this new fund. The tax number that changed everything. The new fund is called QDVO. It launched in August of 2024. Since then, it's been one of the fastest growing high-income ETFs on the market. Its assets are climbing toward $1 billion. And here is why people are excited. QDVO is actively managed. A team picks the stocks. A team decides which ones to write covered calls on. They don't write calls on every stock in the fund. They write them on only some. That leaves room for the other stocks to keep climbing. Plain English, a covered call is when you own a stock and sell someone the right to buy it from you later. You collect cash today. In exchange, you give up some of the upside. QDVO does this on only part of its portfolio. That is the part the marketing loves. The fund yields around 10%. Total returns over the past year are strong. They're right in the same range as QQQI. And there is one more piece. The marketing says QDVO is highly tax efficient. It uses something called return of capital. Let me explain that in plain English. Return of capital is a tax label. It is the IRS saying that part of your distribution is not taxable income this year. Instead, it lowers your cost basis in the shares. So it is tax deferral, not a tax break. But for income investors, deferral is gold. The longer you put off the tax, the more your money compounds. All through last year, QDVO's monthly notices to shareholders estimated something incredible. They projected that about 97% of the distributions would end up classified as return of capital. Investors saw those numbers, they got excited. Some sold their QQQI to buy QDVO. Then the final tax form came out for 2024. The number was not 97%. It was about 11%. 89% of those distributions ended up taxed as ordinary income. That's the same rate you pay on a paycheck. The reversal was massive. Now here's the part most YouTubers will not tell you, and I want to be straight with you. In the next tax year, 2025, QDVO bounced back. The final tax form for 2025 showed roughly 93% return of capital, almost what the marketing promised in the first place. So QDVO can be tax efficient when the right conditions line up inside the fund. The problem is, you do not know in advance which kind of year you're walking into. The 2024 reversal was real. The 2025 recovery was real. Both happened in the same fund, same managers, same strategy. And that's the lesson. With QDVO, tax efficiency is a moving target. With QQQI, it's built into the machine. Which raises the next question. How does QQQI hit 95 to 99% return of capital every single year, like clockwork? The answer is not in the managers, it's in the type of options they sell. Why QQQI's tax edge isn't an accident. Here's the real difference between these two funds. QDVO writes covered calls on individual stocks, Apple, Nvidia, Microsoft, names you know. When you write a call option on a single stock, that option gets taxed like a normal trade. The premium counts as ordinary income or short-term capital gain. There is no special treatment. QQQI does something different. It does not write calls on individual stocks at all. It writes them on the entire NASDAQ 100, the index itself, and that one detail changes everything. Index options like these qualify under a special rule in the tax code. The rule is called Section 1256. In plain English, Section 1256 tells the IRS to treat those options as 60% long-term capital gain and 40% short-term capital gain, every single trade, no matter how long the fund held it. That's a huge advantage. Long-term capital gains are taxed at lower rates than ordinary income. So even when QQQI's options generate big premiums, the favorable tax treatment is already baked in. On top of that, QQQI's managers harvest losses across their positions every year. That means they sell losing trades on purpose to offset the winning ones. The combination of Section 1256 and active loss harvesting lets them classify the bulk of monthly distributions as return of capital, year after year. We're talking about 95 to 99% classified as return of capital in both 2024 and 2025. That's not luck, that's structure. QDVO does not have access to Section 1256. They write calls on individual stocks, not on the index, so their tax treatment depends entirely on what happened inside the fund that specific year. Sometimes the math works, sometimes it doesn't. With QQQI, the answer is roughly the same year after year. So that's QQQI versus QDVO on taxes. But there's a third fund in this conversation. A lot of retirees are still holding it without realizing what it's doing to their tax bill, and the gap is bigger than most people think. Where JEPQ quietly falls behind. That third fund is JEPQ, JP Morgan's NASDAQ Equity Premium Income ETF. It is the giant of this category, over $34 billion under management. Many retirees own JEPQ because of the JP Morgan name, and that name is worth something. JP Morgan runs the fund well. The drawdowns have been reasonable. The yield has been steady at around 10%. But here is what most people do not know about JEPQ. JEPQ does not write its own options. It buys something called an equity-linked note. Plain English, an equity-linked note is a contract with a big bank, Goldman Sachs, Citigroup, Royal Bank of Canada. The bank promises to pay JEPQ a stream of income that mimics what a covered call would do. JEPQ owns those notes. Now, here is the tax problem with that setup. Equity-linked notes pay out as ordinary income. Almost 100% of JEPQ's distributions are taxed at your regular income tax rate. Not 60-40, not return of capital, just ordinary income, same rate as a paycheck. For someone holding JEPQ inside a Roth IRA, this does not matter. The Roth shields it from taxes completely. But for someone holding JEPQ in a regular brokerage account, this is where money quietly disappears every single year, and it disappears in a way you don't see until you actually sit down to do your taxes. Now, this is also where QDVO actually belongs in this conversation. If you are holding JEPQ in a taxable account, QDVO is a real upgrade. Similar yield range, better tax treatment than equity-linked notes even in a weak year, and more upside participation because QDVO writes calls on only a portion of its holdings. That is the swap that actually makes sense. QDVO replaces JEPQ. QDVO does not replace QQQI. Before I show you the dollar math on all of this, drop a comment right now. Are you holding QQQI, QDVO, JEPQ, or some mix of these in your account? Tell me what you own and what you're wrestling with. I read every single comment, and your questions help shape the next video on this channel. Now, let's get to the part that matters most. How much money are we actually talking about here? Because percentages and acronyms only mean something when you put real dollars next to them. The more in my pocket math. Let me show you what this looks like in real life. Ray and Marjorie are 68, retired in Tampa. They have $100,000 of income money sitting in a regular brokerage account, not a Roth, a taxable account. They are in the 22% federal tax bracket. They want monthly income they can count on. Option 1, they put it all in JEPQ. At today's distribution rate near 10%, they receive about $10,100 in distributions over the year. Almost every single dollar is taxed as ordinary income. At a 22% federal rate, they owe roughly $2,222 in tax this year. They keep about $7,878. Option 2, they put the same $100,000 in QQQI. The distribution rate is higher, near 14%, so they receive around $13,500 in distributions. But here is where the magic happens. About 99% of that money is classified as return of capital. The IRS does not tax that this year, so Ray and Marjorie keep almost all of it. Roughly $13,300 stays in their pocket. Their cost basis simply goes down by the same amount. The tax comes later, if at all, when they sell the shares. And if they hold those shares until death, their heirs get a step up in basis. The deferred tax can disappear entirely. That's a difference of more than $5,000 in a single year on one $100,000 position. And that gap repeats every year as long as the tax structures hold. Now, let's compare to QDVO in the same scenario. In 2025, QDVO's tax treatment was about 93% return of capital, so Ray and Marjorie would have kept most of their distributions tax-free that year too. The dollar gap between QDVO and QQQI in 2025 would have been small. But in 2024, it was a completely different story. Same fund, same managers. About 89% of distributions ended up taxed as ordinary income. Ray and Marjorie would have owed thousands of dollars more in tax that year compared to a holder of QQQI. That's the whole point. The amount you keep with QDVO depends on which year you happen to be in. With QQQI, the answer was the same in 2024. The answer was the same in 2025. The answer will most likely be the same next year and the year after that. Reliable tax treatment beats marketed tax treatment every single year. Now, I owe you one more piece of honesty here. Return of capital is not free money, it is deferral. Every time QQQI pays you a return of capital distribution, your cost basis in the fund drops by the same amount. Eventually, if you sell those shares, you will owe capital gains tax on the difference between your sale price and your reduced basis. The way most retirees actually avoid that tax is by holding the shares until they pass on. Their heirs receive a step up in basis. The deferred tax can disappear entirely. So, if you are using these funds for income in retirement and you plan to leave them in your estate, the math gets even better. If you plan to sell during retirement, just know that the tax is delayed, not erased. Either way, deferral is still a powerful tool. Money that stays with you compounds. Money that goes to the IRS does not. So I'm keeping QQQI, but I want to be fair to QDVO. There is one scenario where QDVO actually belongs in your portfolio, and it's not the one most videos are telling you about.
When QDVO actually earns a spot, QDVO has a real role for the right investor. 3 scenarios make sense. First, if you are holding QDVO inside a Roth IRA, none of the tax conversation we just had matters at all. The Roth shields it. So the question becomes which fund you simply like better on returns and strategy. QDVO has held its own against QQQI on total return. Both delivered around 30% over the past year. QDVO had a slightly smaller drawdown because it doesn't cap the upside on every stock. If that style fits inside your Roth, QDVO is a perfectly fine choice. Second, if you currently own JEPQ in a taxable account, QDVO is a real upgrade for you. Similar yield range, better tax treatment than equity-linked notes even in a weaker year, and more room for the underlying stocks to run because QDVO writes calls on only a portion of its holdings. That is the swap that makes sense. Third, if you want concentrated exposure to specific tech leaders like NVIDIA, QDVO leans heavier on them. Around 12% of the fund is in NVIDIA at the top of the portfolio. That's higher than QQQI, higher than JEPQ. If that is the bet you want to make, QDVO is built for it. What I would not do is sell QQQI to buy QDVO inside a regular brokerage account. The yield is higher with QQQI. The tax treatment is more reliable with QQQI. The mechanism is structural, not circumstantial. Here's the myth. A new fund with active management and tactical calls must be smarter than an older fund with a passive index strategy. Here's the truth. For after-tax income inside a brokerage account, the right structure beats the right marketing every single time. If you know someone holding JEPQ or QDVO in a brokerage account, share this video with them right now. The difference between paying ordinary income tax and deferring it could mean thousands of dollars over the next few years. It might be the most useful thing you share all month. And drop one more comment before you go. Are these funds inside your Roth IRA, your traditional IRA, or a regular brokerage account? Because the answer changes everything I just said. Tell me where you have them, and I'll help you think through it in the comments. If you're building retirement income and you want to stay ahead of changes like this one, subscribe to this channel. I cover everything that protects your income and keeps more of it in your pocket. And in the next video, I'm going to walk you through the one tax rule change that could end QQQI's edge overnight, what it would look like, how to spot the warning signs early, and what to do before it ever happens. See you in the next one.